Yo, Thursday. Right, let's start in the world of these PMI things. Purchasing Managers Index. This was put up because it's quite amusing, in a queer sort of way, that PMI manufacturing on the left and PMI services on the right, one country is at the top of both of them. Alright, hello there. It's the Irish. Miracle of all miracles, the Irish are at the top of both PMI manufacturing and PMI services. It's only 52 for manufacturing and 54 for services, which is only just above the 50 line, which is the difference between contraction and expansion, but they are there. Obviously more important is that the US is the big place that's at the top of both. Not contracting, it is expanding in manufacturing and services. 51 for manufacturing and 54 for services. It's not brilliant, it's only just expanding, but the United States is expanding. This is what I keep going on about. On the manufacturing side, there are only two other countries in this list at least that are expanding, and that's the Netherlands, Holland, and Denmark. On the services side, we've got China also expanding. So you've got United States and China expanding, so that's pretty good. And the United Kingdom, so that's another big country expanding. And Denmark, just about expanding. So Denmark's doing, always surprising me, Denmark. I don't know how it does it, but little round of applause for Denmark for surprising Mystic. And Denmark's expanding. So all in all, that is not too bad. There is expansion, certainly in services, in China and the US and the UK, which is very positive. But really the only manufacturing expansion is in the United States. And underneath, in contraction in reddy pink colour, is China, Norway, Japan. The global index is down there at 49, just about contracting. United Kingdom, Germany, the whole of the Eurozone at 46. In other words, there's an awful lot that's contracting, and the question is, all the time I keep repeating it, will the rest, all those in pink, be enough to pull the United States down? And over on the services side, Germany, Norway, Sweden, the Euro composite, down at 46. 46 is very low, and that's for services, and 46 for manufacturing too. It's low. It really is. Eurozone is really a drag on the world. Another important one, and why I'm keeping on with this particular chart, if we go down to the bottom, on the services side, reading upwards, we go Spain and Italy in services. We can imagine those two peripheral countries, Spain and Italy, being there, but France is third from the bottom on the services side. Over on the manufacturing side, it goes Greece at the bottom. We can expect that. And then France on the manufacturing side. And what we have in Europe, which we know is contracting, is the core and peripheral problem. And France, it always kind of, well, what do we do with France? Is France a core country? Not really. Is France a peripheral country, like Greece, Portugal, Italy, Spain? Not really. But on these readings, France is very, very much moving towards the peripheral side, and that is going to tip Europe very much into recession. Okay, so I'll leave that chart there, and we'll move on to this next one from streettalklive.com. And this goes back to 1995, and we've got the GDPs of Europe in blue and the United States in red. Those dotted boxes are where they've gone apart, but the reading from this is they never stay apart long, and at the moment they're apart. So what is going to happen? Basically, this is the question: is Europe going to be dragged up by America, or is America, the United States, going to get dragged down by Europe? One of the two is probably going to happen, and the betting is, because the rest of the world has a tendency towards contraction, that the United States is going to get dragged down by Europe. Right. So what do the powers that be do about all this? We know that the G7 meetings in 2009, where Gordon Brown saved the world, the world leaders got together and did fiscal expansionary things. They spent big, governments spent big, and made some efforts to pull the world out of the recession. But the great big talk now is of austerity, and we've not heard anything from the G7, G9, G20, G anything. Governments are very quiet about everything, and it's all falling on the central banks. These are the central banks: UK, US, Euro area, ECB, and the Japanese central bank, and we can see that balance sheets have been expanding and expanding at the central banks. This goes up to, it's right up to date, and that red line of the US going up the least will obviously go up with the new announcement from the Fed about 40 billion a month of buying of mortgage-backed securities. So the Fed's going to catch up the ECB, the Japanese Central Bank, and the Bank of England. But is it enough? Is it doing anything, in fact? So let's move on to Sprachanalyst, also Sprachanalyst, who is quoting David Bloom from HSBC, who writes, before the Fed and the Bank of England initially embarked on the quantitative easing programs, the perception in the market was that QE would be unambiguously currency negative. If you did it, your currency would go down. This was based on the simple transmission mechanism that the more of a currency printed, the more the currency should depreciate. The market also believed that it would also create inflation, thereby undermining the currency's value, i.e. keeping with the quantity theory of money, MV equals PT. That's going back to Irving Fisher, MV, money velocity equals price transactions. These perceptions have changed. Lots of things have happened, and ideas have changed since 2009. QE is no longer viewed in such simple terms, and there is considerable debate in the market as to what QE means for a currency. With the US, Japan, Eurozone and UK all embarking on expansionary monetary programs, we discuss, with the demise of carry trade, what we believe the impact of QE is for their respective currencies. These ideas are held by the market now, but could change on a dime, or perhaps trillions upon trillions of dimes. In other words, this is what the market currently thinks of QE, but they've changed their mind once and could well change their mind again. Later in this article we get, so what are these ideas currently held by the market now? And this is quite interesting, I hope for you. For the US currency, the dollar, quantitative easing is US dollar negative. Resultant risk-on mood, the market gets different moods. You know, they're talking about risk-on, risk-off, and it can go daily risk-on, risk-off, or monthly risk-on, risk-off. Takes us to higher yielding, more risky currencies. That's risk-on. Risk-off when everyone's feeling scared. And the US dollar is safe haven status. Yeah, when they're feeling scared, people run to the dollar. When feeling risky, they'll go out and invest in emerging markets and things. For the Eurozone, quantitative easing is euro positive. Non-conventional easing as lowering the probability of a euro default and disintegration, thereby boosting the euro. The euro currency, you don't want to hold it if you think the euro is going to blow up. But the market's idea is the euro is less likely to blow up as long as the central bank keeps paying for things. Japan, quantitative easing is mildly Jappy, Japanese yen positive. JGB purchases, Japanese government bond purchases, have little Japan yen effect, but equity market boost encourages foreign capital flows. More money is printed, making the companies better to invest in. So more money comes into Japan. In the United Kingdom, quantitative easing is pound neutral. They got a boost from it right at the beginning, the Bank of England, because they were first at it. So they got a good reduction of the pound in first. And since then it's been neutral. Little currency impact as unconventional monetary easing, that's the QE, seen as appropriate mirror to the ongoing tightening in fiscal policy. In other words, the government's doing their semi-austerity in the United Kingdom, so the central bank, it's best that it is loose. If a government is doing austerity, it's best that the central bank is loose. That's what's happening in the UK, so the market thinks that's a balanced approach, so the pound is not affected by either, because it's seen as a balanced way of going about things. Okay, right, moving on. This is from Market Watch. There have been lots of good articles on quantitative easing. I've just chosen from the best of them this week. The real danger with permanent, now we've moved on to permanent quantitative easing, is not inflation at all. It is that savings rates will be destroyed. Savings will be destroyed. And that capital will end up being invested in all the wrong things. People aren't looking for positive investment opportunities to build and make things and thereby make their money. They're just looking to keep hold of as much capital as they've got, as much money as they've got. Decent investments aren't being made. Take a look at what quantitative easing is actually trying to achieve. The main objective is to reduce long-term interest rates. We must agree there, but if you are a saver, it is not hard to figure out that you are getting a worse deal than you should be. The central bank is driving down the returns you can earn on your money. In effect, it is rigging the market against you. The result, if you have any sense, you will stop saving. And from later in that article, we'll finish with, I think we finish here, yep. So the real problem with quantitative easing is not that it sparks inflation. In truth, there is not much sign of that, at least not the near hyperinflation that the anti-quantitative easing crowd predicted. It is that it destroys saving and savings, and there is plenty of evidence of that happening. And once savings stop, investment will stop as well, and then it will be impossible for economies to grow. This is the big problem. Governments aren't doing it. Central banks are doing what they do, and this is what they do, the quantitative easing. And what does that do? The market is kind of working out that it keeps things afloat in the short term, but absolutely destroys your possibility of a bright future. So all in all, it's not really very good, but nobody yet has thought of anything better. That's it. Bye.